The key differences between two prominent cruise line companies, CCL and NCLH, lie in their financial portfolios. CCL boasts a larger market capitalization, higher net income and revenue, and provides dividends to its investors. However, it also has a higher debt margin and a lower total profit margin. In contrast, NCLH has a smaller market capitalization, net income, and revenue, and does not offer dividends. Despite this, NCLH's financial portfolio is somewhat offset by its lower cash spending rate, indicating a more prudent approach to financial management. In terms of valuation, CCL appears to be undervalued, trading below its price-to-sales and price-to-book ratios compared to NCLH. This suggests that CCL may be a more attractive option for investors looking for a potentially undervalued stock. On the other hand, NCLH's higher price-to-cash flow and price-to-free cash flow ratios indicate a stronger cash flow generation per share. When it comes to revenue growth, NCLH has demonstrated a more impressive recovery from the COVID-19 pandemic, with its revenue and earnings per share predicted to grow at higher rates over the next 5 years. CCL, however, has suffered a more significant loss in earnings per share and has experienced slower revenue growth. Despite these differences, both companies share some similarities. As cruise line companies, they have both been severely impacted by the pandemic and subsequent travel restrictions, resulting in significant losses, suspended operations, and reduced capacity. Additionally, both companies have reported negative returns on their net income. Ultimately, the decision between CCL and NCLH depends on individual investor preferences. CCL's broad financial portfolio, lower valuation, and decent growth prospects make it an attractive option. However, NCLH's financial recovery possibilities, lower cash spending rate, and effective pricing strategy make it a more compelling choice. Overall, NCLH appears to have a slight edge